Hello and welcome everyone to Stock Talk. I have with me Mr. Pankaj Pandey, our head of research, and it's an exciting episode planned for you today. Sir, we have lots to discuss about, starting from the outlook of the markets. We have Q2 FY26 earnings to decode, and we also are going to learn from you how do you exactly analyze a stock. We'll take an example and try to analyze it together. And finally, we'll round it off with a nice hidden gem. So let's start from the beginning. What are the markets saying right now? What is the outlook like?
So hi Vishu, yes, last 2 months have been really fruitful for the markets. We've seen, especially for the month of November, our markets are up about 1.5%. Compared to that, global markets are down in the range of 2 to 3 odd percent, especially US markets. Market like Japanese market is down somewhere about 5-6 odd percent. See, globally markets have been rallying largely because of the AI related trade. Now there are concerns in terms of stretched valuation there, and which is why some of these stocks have started to wobble. And as a result of that, it is having a slight positive rub-off on Indian markets, because India was not expected to be a market which was driven by AI-led theme. And so since globally AI related theme has started to wobble, our markets have started to do well. So we are literally 0.5% away from making a new lifetime high. In fact, some of the indices, like say for example, Bank Nifty has already made a new lifetime high. Even the mid cap index has already made a new lifetime high. I think the small cap is struggling, is down about or still 9 to 10% away from high. But our sense is that once this trade deal happens, so timing is very bit difficult, because we have been sort of looking at this deal for quite some time. But as and when this gets announced, our sense is that the market should make a new high and possibly go to levels like say 26,800. So 800 points kind of upside from current levels. Support could be somewhere about 400 points below, so somewhere about 25,600 kind of a level. Now, when the trade deals sort of get announced, what will happen is that it is beneficial for mid caps and small caps, because earning wise they have been doing fine. It is the sentiments which have sort of pulling these segments down. And I think overall you will have a lot of other sectors which will benefit, the likes of IT. Besides that, Pharma is also a sector where exports happen, though there are no tariffs there. But sentimentally, it gets impacted. And I think textile would be another sector which has taken a good amount of knock because of the overall trade-related challenges which a lot of these companies are struggling with. So our sense is that new highs on the horizon, and it is contingent upon as and when the trade deal gets announced. Largely post Bihar election, there is a policy continuity expected both at the center and at the state level. So, so most of the macro parameters are absolutely fine for us. So I think trade deal is the probably only variable which is left, which will probably propel the markets to new highs.
How do you analyze a stock, and what are the readings that must be read? Let's take an example of a stock and then analyze it.
So yes, Vishu, a lot of things go into when you sort of selecting or when you sort of select a stock. But just to sort of, if I have to put a mental framework, I think it needs to be a combination of 2-3 things. One, I think if you are analyzing a stock, you need to be sure that the kind of opportunity this stock can cater to. And the second is obviously how is this company positioned to sort of do that. And third, obviously, is the overall valuation and other parameters what you look at. And besides that, a lot of other hygiene factors, which I will not discuss for want of time. Now, if I have to sort of give an example, let's look at a very well-known name like, say, Titan. Now, this stock has done nearly, say, 10x kind of a return in the last 10 years. So when you look at jewelry as a segment, see the entire industry is somewhere about 7.5 lakh crores. Now, Titan has got a top line of nearly 60,000 odd crores. A bulk of it is coming from the jewelry segment. Now, this out of the 7.5 lakh crore, so this company has got some 7-8 odd % kind of a market share. Organized pie is only 40%. So within that organized, this company is somewhere about 20 odd % of the overall share. So from an industry perspective, it's a big industry, 7.5 lakh crore. The biggest player is sitting on a top line of some 60,000 odd crore. So obviously it has a lot more room to grow because you have an unorganized segment. Now, unorganized segment obviously will not be able to compete structurally, because we are seeing more nuclear families. As urbanization, as a trend picks up, people move to cities, and then local connect with your with the jeweler sort of wanes off. So Titan will be a clear beneficiary because somewhere down the line, I would want to believe that jewelry is a business of trust. And obviously, Tata carries a good amount of trust, or one of the most trusted brand, I would say. So opportunity pie is large. This company can grow. It has already done very well in the last 10 years. Now, within the segment, this company is placed very well. I mean, just to sort of highlight the kind of pricing power it has. So in the jewelry side, this company makes a margin of 10 to 11 odd %. You look at the competition, they would make margins in the range of say 5 to 6 odd %. So obviously, because of the trust it carries, this company has got a certain niche, and which is why it is able to sort of garner a higher margin. So both the variables are fine. Now let's look at on the valuation aspect. Now this company is trading somewhere about 48 to 49 times on a forward basis. So valuations definitely look rich, but most of your consumption related stories would trade at similar multiples. Now we all know that gold prices have done phenomenally well. People have limited money to sort of purchase, so which is why now you're seeing the advent of 18 karat jewelries or 9 karat jewelries, and with far more design options. So Titan has been sort of offering all of this, and the way they have delivered a high teen kind of a growth, expectation is that they will continue to sort of deliver a high teen kind of a growth. So this stock may not be very attractive from a 1 or 2 year perspective because of the rich valuations, but if you sort of wait it out for a longer period of time, the way it has panned out in the last 8 to 10 odd years, something similar is expected. So which is why this stock makes a good case from a consumption perspective. I hope I have sort of explained how to sort of put a mental context to when you sort of approach a stock.
Right. Sir, Q2 FY26's earnings have been made out, and how would you look at the picture right now, and regarding the valuations of our markets right now? Given these earnings, are we still overvalued, or is it in a comfortable zone right now?
So Vishu, on the earnings side, I think this last quarter was pretty good because if I look at the overall consolidated earnings of all the companies which are listed in India, after 5 quarters, we are seeing a double-digit profit growth. So profit growth was about 12 odd %. So broad basis earnings are back. Even if I sort of break it segment-wise, say let's look at a big chunk like say Nifty. Now in Nifty, while the overall top line growth is somewhere about 8 odd %, bottom line growth looks quite subdued or muted at about 3 odd %, against the overall market expectation of some 7 to 8 odd % kind of a growth. But if you sort of strip out some of the segments, say for example, Tata Motors, last year this was making profits of 3,500 crores. But because of cyber incident, now it is making a loss of, or it made a loss of 3,500 odd crores. Then I think on a 2 lakh crore kind of average profit in Nifty, that's a delta of nearly 4 odd %. So if you sort of strip that out, and even if I look at the BFSI earnings, so this particular quarter, what we have clearly seen is that the bank Nifty earnings or banking earnings have bottomed out, because quarter on quarter and YOY basis, there is an improvement in the earnings. So if you sort of strip out the underperforming segments like say BFSI or Tata Motors, The top line growth for Nifty is about closer to 10 odd %. The bottom line growth is also 10 odd %, which is impressive, which again is it is coming into double digits after 5 quarters. And mid caps, the earnings have been pretty good, about 25% kind of earning growth. And small caps, again, 18% kind of earning growth. So that is also pretty impressive. So the overall earning growth spread has been pretty good across segments. So from that perspective, I think earnings have been pretty good. And when we sort of roll these earnings to FY28, we are looking at somewhere about 12.5% kind of earning growth. And we are keeping or we are giving a P multiple of 21. So that gives a target of 29,500 for Nifty, and which again is an upside of 12 to 13 odd % from current levels. Now, our sense is that from a valuation perspective, see, historically people compare that the Nifty has traded in the range of say 16 to 18 multiples on a forward basis. So why is this 20 or 21 considered rich? But I think what we also need to understand that if you look at the last 5 to 6 or 5 to 7 inclusions and exclusion in the index, the companies which have moved out of the index are lower P rated stocks. Whereas what has come in is expensive ones, because a lot of these traditional business models are sort of moving out. We all know that a lot of consumption pattern is changing. So which is why you are seeing newer category of stocks coming in. So what has gone out is, say for example, about 18, 19 kind of a PE multiple, and what has come in is literally 38 kind of a PE multiple. So naturally, the PE multiples for the index will also reflect the kind of stocks what it carries. So which is why I feel that while yes, relative to market, it is a rich multiple, but I think since growth is coming back, India is known for its growth. So growth story is coming back in India, and which is why I feel that the markets are expected to do well over the next 1 year. And I'll not be surprised if next year, 2026, could be a year of mid caps and small caps, given the relative better growth rate what this segment is delivering.
Absolutely. So one of the reasons that markets have kind of stayed flat in the past year is FIIs, of course, the foreign investors. Do you think they would also look at the picture the same way, and will they be coming back anytime soon?
So Vishu, bit difficult to say how the FPIs will react, but I think December is a month where we don't expect too much of a FPI outflow because of the festive season. But just to sort of put some numbers, I think this year FPIs have sold somewhere about 2.1 lakh crores. So while yes, primary market has been very buoyant, we've seen number of IPOs. So FPIs have put about 62,000 odd crores in primary market. But despite that, we are still seeing a net sales of somewhere about 1.5 lakh crores. Now, when that happens, obviously the market does not perform, and which is what has happened to Nifty, because FPIs typically operate in top 200, 300 stocks. And while the domestic inflows have been pretty good, so domestic inflows is so SIP is inching closer to about 30,000 odd crores on a monthly basis. While that is sort of cushioning the market, but you need FPI flows to sort of come in, and which is why some of the big sectors like say BFSI hasn't really performed to the potential. So our sense is that with global AI related theme at least wobbling, you will see probably some bit of a allocation coming back to a market like ours, because eventually earnings are also sort of coming back. So I'm very hopeful of FPIs coming back, and that should help a big sector like BFSI. But I think trade deal is very important for the mid caps and small caps to do well, because sentimentally it provides them a boost. Otherwise, people tend to sort of believe that there's some wrong somewhere in the markets, which is why a lot of stocks are not sort of doing so well.
Yeah. Absolutely. All right. So let's get to the sectors. I think you mentioned BFSI already. So let's take that one up first, and then we'll go to IT. So what's the outlook on BFSI?
So BFSI is a very important sector from a Nifty perspective, because on a forward basis, it contributes nearly 43% of the earnings for Nifty. And weightage wise, it is somewhere about 36.5%. Now in BFSI, at least what we are clearly now seeing is that the credit growth has started to improve. So now it has come back to sort of double digits. Expected that in the second half, it should improve by 1 or 2 odd percentage point because of the GST cut. A lot of consumption or discretionary consumption is expected to pick up, especially segments like auto. Then I think asset quality has been quite good. So that is not a challenge for banks. I think the only challenge for banks was that in this first half of the calendar year, the RBI had cut rates by 100 bips. Now, when you sort of cut rates at such an intense pace, the cost of funds, while it sort of does not come down so much, but the yield on advances, because they need to necessarily pass that on interest rate cut to the consumer. So which is why you see a pressure on the margins. The pressure on the margins for private sector banks or private banks is a lot more higher because of their overall portfolio. 60% is EBLR linked. So basically, if the repo rate gets cut, they need to necessarily pass it on. For PSU banks, this number is about 45 odd percent. So which is why a bank like SBI has seen, in fact, margins expanding in this particular quarter, whereas some of the private sector banks like say HDFC Bank has seen a margin compression of 6 to 7 odd bips. So, but despite all this, overall, in this particular quarter, we have seen earnings improving both quarter on quarter and YoY wise. Now, the biggest question is that since the inflation is already at 0.5%, would RBI sort of go in for a rate cut? So our sense is that 25 bips kind of a rate cut is very much possible, largely a sort of a done deal. And that is a sort of a manageable number. But in case if the RBI goes for a 50 bips kind of a rate cut, then I think the earnings again might, or the margins might again come under pressure. While it's a technical issue, the earnings get postponed because somewhere down the line, the cost of deposit also sort of gets rationalized. But since the yield on advances get rationalized first, so which is why you see compression in earnings. So if a 25 bips rate cut is there, my sense is that the BFSI as a segment should do well. Up till now, retail, MSME has been sort of doing well. Banks have not been chasing unsecured segment. But our sense is that unsecured plus corporate segment can make a comeback because the RBI has made a certain or has given certain leeway to banks. So overall, we are sensing a pretty broad-based growth in the banking earnings. So BFSI looks in pretty good shape. BFSI needs to perform for Nifty to make a new high.
Absolutely. So considering all of these factors, which company do you or which stock do you think stands out in BFSI?
So in BFSI, we have already recommended HDFC Bank as part of Muhurat pick. I think that stock still looks good to us. But in case if I have to add more, probably Kotak Bank and Axis Bank is what I would add to that list.
IT seems to be making a comeback. Like you said, since tech and AI is wobbling around the world, Indian IT is making a comeback. How far will this comeback go?
So IT besides BFSI is the second most important sector, contributes about 10% in terms of weightage. Now this segment hasn't done well and last 3-4 years we have not seen any price performance from most of the companies. Number wise, tier 1 companies would have reported say literally from no growth to 2.5% kind of a dollar revenue growth on a quarter on quarter basis. It is the tier 2 names which are sort of doing well. So outlook again remains muted in the second half. So any meaningful recovery in IT will happen in FY27 onwards only. So you still have some time away. But for IT, what can benefit is that the kind of pessimism which a lot of Indian IT stocks were carrying, I think that can change. See, one, if the global AI related theme sort of cools down, what will happen is that the focus will come to Indian IT companies. And there are some instances where companies are also sort of doing well. So for example, when we look at a company like Accenture, so they have declared that 7% of their overall booking is coming from AI. A company like HCL Tech is saying that 3% of their revenues is coming from AI. So companies have started to sort of take steps there. So initial step is to sort of build a data foundation. So once you build a data foundation, then you do a pilot AI, which is what companies have been doing. And once you sort of do that, once you sort of go into implementation mode, initially what happens that whatever efficiency gains are there, it is passed on to the customer. But in the second phase, some benefit resides with you. So which is why if you notice, companies like say TCS has seen employee attrition of nearly 1% because not all the employees will be relevant in this new AI related development which is sort of going on. So I think pain is already there in most of the IT stocks. Just to give an example, typically a company like TCS used to trade on a 1 year forward basis. The 5-year average is 26 to 27 times on a forward basis. That is the kind of a P multiple they used to trade. Now it is trading somewhere about 21 times. So yes, if this trade reverses from global AI to domestic Indian IT companies, I think Indian IT companies can benefit, and we are seeing some instances of it because this year Indian IT is down about 15%. So I think it's a good contra play on the global AI theme not doing well.
Absolutely. So in this comeback story, which stock are you betting on in the IT sector?
So in IT, I gave an example of TCS. So obviously TCS could be at the forefront because like Accenture, it has got a similar build. So our sense is that it could have also a similar number of AI bookings. So TCS obviously, and besides that, Coforge is another company which can be looked at. Looks good. It is poised to sort of deliver 20% kind of a growth.
Absolutely. Sir, another sector which is making a good comeback after staying sideways for a while is oil and gas. In the past few months, we have seen some good green candles there. What is happening in this sector?
So oil and gas is one of the few sectors which has seen a good earning growth, and largely because of the GRMs being better. Now, one thing is very sure that crude oil prices are not going to spike in a big way. So obviously marketing side, if the retail prices of petrol and diesel do not change, the companies will make money on the marketing side. Now on the GRM side, which is what the money they make on for refining or when they buy crude oil and then make products such as petrol and diesel. See, the GRMs last year or even quarter before was in the range of $3 to $3.50 per barrel. That sort of improved to about 10 odd barrels and is still sort of staying strong. So which is why Q2 was a pretty good quarter for oil marketing companies or oil companies. I'm not saying the upstream companies like ONGC Oil India, but when you look at IOC, BPCL, all of them made GRMs of about 10 odd dollars. Last quarter or last year, it was about in the range of 3 to 4 odd. So from that perspective, these companies have done very well. And my sense is that for the next 1 or 2 quarters, they are still poised to sort of do very well financially. And again, depends on how the crude oil behaves, but I think the setup looks positive even for 1 year down the line as well for these companies.
And which one does stand out in the, which company does stand out in the oil and gas sector?
So Reliance is the biggest company, has got multiple businesses. So I think Reliance makes the case for the company in the oil and gas sector.
Right. And how about Pharma? Traditionally, it's been considered a defensive sector, but I think this time around it has been leading from the front.
So Pharma, again, you need to sort of break it into multiple geographies because India is considered to be the pharmacy of the world. So US is one of the biggest markets, no doubt. But growth in US is quite tepid at 5% last quarter for the top pharma exporters. And the rest of the market did well. India growth was somewhere about 9%. Now in the US market, there is a pricing pressure which is going on. So most of these companies continue to witness pricing pressure. But things are changing there. A company like Sun Pharma is venturing into complex products, so which is not a generic and does not face the kind of a price competition. So things are changing at a slower pace. I expect a steady set of numbers from Pharma. So 12% is the earning growth was there or top line growth last quarter. And I would expect a low teen kind of a growth to be there. And again, depending on the kind of product launches, but in general, Pharma looks to be sort of stabilizing. Can be better, but US market we are still not very sure of. So domestic and rest of the world is doing absolutely fine for Pharma.
So in the pharma sector, which company looks the most lucrative right now?
So Sun Pharma is doing absolutely fine, pretty good because of the kind of niche exposure they've got to the US market. And in addition to that, domestically, Torrent Pharma is doing very well.
Moving on to FMCG as a sector, what are the trends are you seeing there?
So Vishu, FMCG had seen a volume impact of 1 to 2% because of the GST transition, because a lot of products came under GST at 5%. So we expect that in the second half, the growth should be 1 to 2% higher than what we have seen historically. But largely the pattern remains same. The rural market continues to sort of do well compared to our urban markets. I think food companies are something which are sort of doing relatively well because of the higher penetration what they can do. So Marico is our topic there. I think this is one of the few companies. The food portfolio is growing in double digits, and it can sort of keep on doing well. So Marico remains the topic. Besides that, Tata Consumer could be there another one.
Absolutely. So Marico and Tata Consumers. In defense sector, I think it has caught the investors' eye. It has been catching the eye for a while now. What are you seeing in defense?
So defense earnings should not be viewed from a quarter perspective because it's very lumpy in nature. Most of your defense stocks are sitting on 5 times order book to bill ratio. So they have got work for next 5 years. And quarterly, you'll see a lot more gyration sort of happening. So ideally, it should be looked at on a half-yearly basis or on an annual basis. And our sense is that most of the companies will continue to sort of deliver mid to high teen kind of a growth. What we prefer is less lumpiness in business. So from that perspective, Bharat Electronics is something which remains our top pick, because electronic is something which is required across platforms, be it Air Force, Navy, or Army. So from that perspective, Bharat Electronic is one of the few companies which have been doing very consistently good set of numbers. Order book is quite stable. So that should be the one, or that is the top pick in the defense side.
And how about metal sector? It is considered very volatile, but what has happened this quarter?
So you are right. It's been volatile because despite putting 12% safeguard duty, metal stocks haven't performed because China still continues to overproduce and continues to sort of dump. The steel prices are at 1-year low at about 47,000 rupees a ton. And so we were expecting some bit of a margin pressure is definitely there for metal companies. Tata Steel relatively did well. For them, the margin decline was only about 300-400 odd rupees for the domestic operations. Globally, their operations in Netherlands is expected to become better. And valuation-wise also, it's quite relatively attractive. So it's trading at about 6.5 times CBY EBITDA. Compared to that, JSW is at about 9 times. So from that perspective, Tata Steel is what I would prefer. And I think I'm hoping that the government will take some measures so that this kind of dumping from China sort of stops. So that is the premise, because this sector is doing phenomenal amount of capex by almost all the players. So somewhere down the line, the government will come and offer some protectionist measure to the industry.
Absolutely. In the cement sector, in the past few years, we have seen heavy consolidations, and the consolidations had to bear fruit in the coming quarters. How far have we reached there?
So cement companies have seen a pretty phenomenal quarter, the last Q2, because the volume growth was somewhere about 15% odd. A lot of companies are doing organic plus inorganic expansion. So we had something like UltraTech delivering a volume growth of more than 22% odd. Even the pricing compared to last year is better at 5%. But the good part is that everything boils down to good numbers of Q2. The EBITDA per ton sort of also improved. But from here on, since we have already seen GST cut from 28% to 18%, I don't think cement companies are going to sort of hike prices. So in the near term, probably, despite the fact that second half you see a lot more better execution, volume growth could be there, I think pricing growth may not happen. So from that perspective, cement companies probably may not really perform from a price performance perspective. But having said that, I think tier 1 companies like say Ambuja or something like JK Cement has seen a decent amount of correction. So these companies can be looked at in the cement pack.
Absolutely. And how about capital goods? What are the numbers like there?
So capital goods companies are in a pretty steady expansion or execution mode. Where things are lacking is that, see, this year is all about government driving consumption. So we've seen GST cuts, we've seen income tax benefit, and then you had other measures being taken. So in that process, capital goods has taken a back seat. But we've already started discussion around budget. And my sense is that in this budget, you will see things moving in a positive direction for capital goods. So yes, first half may not be so rosy. Second half will become better. In fact, the news flows are expected to become better. Companies like say L&T stands out because they can easily, comfortably deliver mid to high teen kind of a growth. Order inflows are pretty good. Second half could be even more better. They could be exiting Hyderabad Metro, which is a non-productive asset for them. So from that perspective, things are looking good for the entire capital goods space. L&T in particular is what I prefer.
Well, that was it for this time. Thank you so much, Pankaj sir, for your time and insights.